Happy Wednesday, friends. This is Darius Dale here to present our macro minute for Wednesday, September 21st, 2022. Starting with markets, or stocks mixed this morning with U.S. equities leading, commodities mixed with energy leading, crypto up, dollar up, global bond yields down. Market moving headline. So this is the most realistic take we've seen on the Fed in a while, which is that the Fed will probably hike by 75 basis points. Though we can't rule out a 100 basis point move. Traders will be honing in on the dot plot, which Bloomberg Economics sees signaling rates will stay in restrictive territory until 2025. Markets are pricing a peak at 4.5% by March and an end 2023 rate of 4 to 4.25. As we continue to talk about on our program, we're in phase 5 of the global liquidity cycle downturn, particularly with respect to the Fed, which at phase 5 is we all have to accept that there's probably going to be no rate cuts or QE in 2023 without an actual recession. And we certainly believe that if you look at asset market valuations, or if you just look at Eurodollar futures, Fed funds futures, OIS futures themselves, markets continue to expect that this tightening that we've seen thus far will cause the Fed to do an about-face pivot. I'm not so sure that we're even in restrictive territory, nor is 4.5 on the Fed funds rate even all that restrictive in this new economy, which is flush with cash on both consumer and business balance sheets. We talked about that at length in the most recent macro scattering report and in our leadoff morning notes. So go check that out. I actually discussed that this morning in the context of consumer debt. Anyway, no deals equal no growth. The slowdown in PE deal flow, private equity deal flow, will last until late next year at the earliest, with the U.S. economy allegedly about to enter a recession, at least another 150 basis points of rate hikes, per Apollo co-president Scott Kleinman. For those of you who are not familiar, Apollo is one of the largest private equity firms in the world, may in fact be the largest on Wall Street. So the deals have declined about 30% year to date after a record 2021. Though volume of $992 billion is still quite high relative to historical averages. So you're very clearly seeing the Fed's financial tightening work through its way through the credit channel, which is what the private equity industry thrives on. It's being able to access cheap debt, slap the company balance sheets on with debt, do some restructuring, put some lipstick on the pig, and sell it to you 3 to 5 years later. That's kind of the whole industry, and it works. It's actually a great asset class, generally speaking, in terms of the IRRs. But deal flow is obviously very much slowing now. Again, with a lot of investors having a recession as their modal outcome. We talked about this on the program and in our macro scouting report and our research, the most recent on the horn as well, in terms of actual recession is not actually the modal outcome, at least not according to the bond market, the most important market that it matters as it relates to determining whether or not the recession is a high likelihood event. The 10-year 3-month yield curve is yet to invert. And until that inverts, you should not be thinking that an actual recession, i.e. a broad-based decline in income and spending across all sectors of the economy, that is not a modal outcome yet. And until it becomes a modal outcome, it's our view that we're going to continue to see upward pressure on rates, just given the rate dynamics in and across the Fed and across global central banks, and the strong dollar that's really preventing the rest of the world from being able to access our debt markets in terms of capital inflows. And shifting gears, Putin behaving just as we expected he would when backed into a corner. So Putin declared a partial mobilization in Russia from today, vowing to use all available means to defend occupied territory in Ukraine. He plans to call up 300,000 reservists under the order, though not all at once. I don't think they could even train them all at once. It's very clear that they don't have the kind of military logistics capability to succeed in this war in Ukraine. So it's very clearly that they're struggling there. And they've been on the backtrack for the last couple of weeks or so. Putin also ratcheted up threats of a nuclear response to quote unquote Western blackmail. So this is his version of Biden's 60-minute speech. I don't know if you guys caught that on Sunday, but definitely go check that out. It's pretty harsh condemnation of Putin and pretty strong repudiation of anything China might do on Taiwan, effectively pledging to use U.S. force to defend Taiwan. So I thought that was a pretty material step in the direction of deglobalization. Again, and then these types of things play out over years. So don't go put a trade on today based on what Biden said or what Putin just said. But it obviously continues to mean we're moving again the wrong direction to a multipolar world, which is very different than the unipolar world that we sort of entered the pandemic with. And then lastly, crude stockpiles continue to build as U.S. consumers astute driving. U.S. gasoline supply surged more than 3 million barrels last week, the API said to have reported. That would be the biggest increase in 2 months if confirmed by the EIA today. Distillate stockpiles climbed 1.5 million, while crude inventories gained about 1 million. So we've seen a plethora of bearish news for the crude oil markets in recent weeks. None more bearish, in my opinion, than I think it was on last Friday or whatever. The UAE signaled that they will be raising supplies to give, basically draw down their supplies in advance of the green energy transition. They're basically saying, hey, we're sitting on a bunch of oil. We don't want it to go to zero in price, so let's just start selling it. I think we're going to see more and more suppliers respond in that way throughout this decade. I don't think it's all going to happen at once, but soon, the more we get towards this green energy transition, and it may take an actual energy crisis to get to the other side of this. I'm not saying it won't have an energy crisis in between now and then, but towards the end of this transition, we're going to see people start dumping crude oil on the market because, again, producers would rather make some money for their reserves rather than no money in a more electrolyzed world. Is that electrolyzed word? Fact check me on that, folks. Big movers this today. I thought this was pretty interesting. Crude's bouncing nearly 2%. It's off 5% month over month, but bouncing on a negative data point tells you that it's probably done trying to go down at the bare minimum. It's exhausted to the downside. It may need a pause before it continues to make further declines. Silver up 2% this morning in advance of the Fed. So somebody's speculating that we're going to get a dovish pivot. It's up 3% month over month. We talked about this in our leadoff morning note, all the different market setups across asset classes and then various sectors and style factors within the equity markets in terms of what you should be betting on if you're trying to play a hawkish pivot, hawkish surprise, a dovish surprise, et cetera. And then obviously you know where to go in terms of our our portfolio construction in terms of the medium term outlook. So definitely let you go check that out on your own. Getting into our risk management through the lens of our volatility adjusted momentum signals and probable ranges. US dollar, that's bullish FAMs in the middle of the range there. Gold bearish FAMs in the middle of the range there. 10-year nominal treasury of bullish FAMs. You got about 7 basis points of upside to the upper boundary of the probable range. High yield credit spreads, bullish FAMs, middle of the range. S&P 500 neutral FAMs, middle of the range. Fixed bearish FAMs getting towards the upper boundary of the probable range with about 2% upside there. NASDAQ 100 neutral FAMs, middle of the range. Russell 2000 neutral FAMs, middle of the range. Bitcoin bearish FAMs, middle of the range. Very narrow range there. And again, you see these narrow ranges in Bitcoin, it's usually a bear market. It's usually not like, hey, we're about to go, rocket to the upside. So just be careful with that in terms of crypto. Ethereum, we talked about this last year, actually. The vol you see in the cryptocurrency asset class, both implied and realized, tends to come to the upside. So that's when you see the net range narrowing and it's not going anywhere, it's usually telling you that we are in a crypto winter, not heading into a crypto spring or summer. Ethereum a little bit closer to the lower boundary of its probable range, giving back a lot of the gains that investors kind of chased into the merge. The merge, I guess, it merged with the Turkish lira, which again was one of the funnier treats I've seen in recent weeks. Anyway, it's now got 2% to the lower boundary of its probable range. Shanghai Composite neutral FAMs, that's still oversold. WTI bearish FAMs in the middle of its range. Agricultural bearish FAMs, that's overbought this morning. Industrial metals bearish FAMs, you got about 1% of upside to the upper boundary of its probable range. And then today at 12:45, I will be joining the Unusual Wells Twitter Spaces. Got my friend Jim Carson, among others, previewing the FOMC in terms of kind of what to think about into next week's quarterly OPEX and how the asset markets are probably likely to trade beyond that too. So definitely come check us out. And then always hit the subscribe, hit the like button if you like us. And then we appreciate you and appreciate all the support. So catch you back here tomorrow. Cheers.